Japan's Great Unwind, how a yen shock could crash the whole system. Good evening. If you think the global financial system has been stable, think again. Tonight, we dig into a seismic shift that threatens to rattle every corner of global markets. Because what just happened in Japan isn't just a local monetary adjustment, it may be the beginning of the biggest unwind in financial history. Yes, the unwind has started. And whether you're invested in equities, crypto, real estate, or simply holding cash, you need to understand what is unfolding beneath your feet. For decades, Japan was the backbone of cheap global money, a silent engine powering markets, credit, risk, debt, and speculation around the world. But that engine has now reversed. And when a machine built over 30 years reverses direction, the shockwaves are not small, they are seismic. Tonight, we break down exactly what Japan just triggered, why analysts are calling it the biggest unwind in financial history, and how this could reshape every asset class on Earth. From stocks and bonds to crypto and real estate, this is not fear. This is not hype. This is the data, and it is unfolding in real time. Section 1. The End of an Era. For more than a decade, Japan ran the most aggressive ultra-easy monetary policy in the developed world. Zero rates, negative rates, yield curve control, unlimited bond purchases. A monetary experiment unlike anything seen in modern financial history. Japan kept interest rates near zero for decades. It used yield curve control to suppress long-term bond yields. It printed money at unprecedented levels to keep the government financed and the economy stable. But in 2024 and 2025, everything changed. The Bank of Japan ended negative interest rates. It loosened yield curve control. It raised rates to 0.5%, the highest level in 17 years. And with that decision, the global era of free Japanese money came to an end. This wasn't just another central bank shift. It was the collapse of the financial foundation that supported trillions in global liquidity. Section 2. The unwind begins. Once Japan removed the lid from its bond market, long-term yields exploded higher. 20-year bond yields surged. 30-year and 40-year bonds cratered. Auction demand crashed to multi-decade lows. The yield curve steepened violently. What does that mean? Bond prices collapsed. Banks, pension funds, and insurers, all holding massive JGB portfolios, suddenly found their balance sheets under stress. The Japanese government's debt servicing cost soared. And the market that was once considered the world's safest became a potential flashpoint for systemic instability. This was the trigger point. But the shockwave was global. Section 3. The Death of the Carry Trade. For years, Japan's zero-rate environment created the legendary yen carry trade. Borrow yen at near zero cost. Convert the yen to dollars, euros, emerging market currencies, or crypto. Invest in higher-yielding assets abroad. Pocket the difference. It was one of the biggest hidden engines of global liquidity. It fueled U.S. treasuries, European bonds, emerging markets, tech stocks, real estate, crypto, corporate debt. But now that engine is reversing. When Japanese rates rise, the carry trade becomes unprofitable. The yen strengthens. Investors unwind trades. And to unwind a yen carry position, you must sell foreign assets. That means selling U.S. stocks, selling U.S. treasuries, selling European bonds, selling emerging market debt, selling crypto, selling real estate investment trusts, selling anything funded with cheap yen. This is what a global unwind looks like. Section 4. Global fallout. The consequences are now spreading worldwide. Bond markets. Yields are rising globally as Japanese investors repatriate capital to Japan. Long-duration assets are under severe pressure. Bond volatility is rising at levels not seen since 2008. Stock markets. Higher yields kill valuations. Tech stocks and growth stocks are already seeing pressure. Debt-heavy companies face refinancing nightmares. Corporate bankruptcies could surge. Currencies. Emerging markets are at risk of capital flight. Weak currencies get weaker. The dollar faces volatility. The yen whipsaws violently as markets reposition. Real estate. Mortgage rates rise. Commercial real estate, already struggling, faces another shock. Developers face credit tightening. Crypto. Liquidity dries up. Speculation slows. Bitcoin and major crypto assets become more correlated with risk-off behavior. Global debt. Governments with massive debt loads face higher interest costs. Refinancing becomes painful. Fiscal crises become more likely. Section 5. Why this may be worse than 2008. 2008 was caused by mispriced mortgage risk. This crisis is caused by something far deeper: the unwinding of a structural financial foundation that supported global liquidity for decades. The Japanese yen carry trade is not a sideshow. It is not a niche strategy. It is not a minor contributor to markets. It has been one of the core pillars of global finance. When a bubble pops, the damage is severe. But when a pillar collapses, the entire building shakes. This unwind could last years, because it took 30 years to build. Section 6. Scenarios for what comes next. Scenario A. Soft landing. The BOJ manages markets with careful intervention. Yields rise slowly, and global markets adjust gradually. Volatility stays elevated but contained. Scenario B. Hard landing. Bond markets spike. Equities correct 40 to 60%. Emerging markets face crisis. Currencies collapse. Debt defaults increase. Scenario C. Systemic global crisis. Global bond markets freeze. Credit markets seize. Banks face liquidity stress. Emerging markets see capital outflows and possible defaults. Central banks intervene with coordinated emergency measures. In this scenario, Japan's unwind becomes a global shock comparable to, or worse than, 2008. Section 7. How to protect yourself. Increase liquidity. Avoid high leverage investments. Reduce exposure to long-duration bonds. Be cautious with emerging markets. Monitor yen volatility and bond yields. Focus on high-quality assets. Prepare for volatility spikes. Watch debt-heavy sectors and companies closely. Gold, strong cash positions, and short-term quality instruments may offer safety. Section 8. Final message. The world is changing. A quiet shift in Tokyo has triggered a global earthquake. Markets are no longer operating in the same liquidity environment. And the era of cheap yen, the engine of decades of asset inflation, is gone. This unwind won't happen overnight. But it has started. And once it begins, it is nearly impossible to stop. Prepare, position, because what Japan just triggered may reshape global finance for the next decade. Stay informed, stay aware. This is Felix. See you next time. Don't forget to like and subscribe.